In our strategy, we focus on sequencing, not prediction. We care more about how systems behave under stress than headlines, and we manage risk through phases, not opinions. Ray Dalio is warning about capital wars instead of trade wars. That sounds dramatic, but the real question is simpler. Does the plumbing actually support that story right now? This episode responds to commentary from Eurodollar University. We respect the work and encourage watching the original. Our job is to translate the signal into our strategy framework. The claim is not just about politics. It is about foreigners reducing demand for dollar assets, and whether that weakens the dollar system itself. The United States is issuing a lot of debt. Politics are louder and more hostile, so it feels intuitive that capital would walk away. Holding treasuries does not equal leverage. Selling treasuries does not punish the system cleanly. It often hurts the seller first. This happens because global trade runs on dollar funding. When funding tightens, people reach for usable collateral, and that usually increases demand for treasuries, not less. The dollar is not a stock price. Its exchange value reflects funding conditions. A stronger dollar often means stress, not confidence. If funding becomes scarce, risk assets feel it first. Equities with long-duration cash flows become fragile. This is a plumbing issue, not a popularity contest. In our strategy, this fits a Phase 2 mindset. Durability matters more than upside chasing. Optionality matters more than conviction. Dollar-dependent borrowers feel stress first, then emerging markets, then concentrated equity leadership. Flow data still shows strong private foreign demand. That does not eliminate risk, but it lowers the odds of an immediate buyer strike. We downgrade headline-driven dollar collapse stories. We upgrade funding stress and auction behavior. Plumbing signals move the framework. Debt levels still matter. Liquidity can still roll over quickly. Phase transitions can compress fast. Quick note here. This is educational macro commentary, not financial advice. We are describing process and risk management only. Near-term continuation remains possible. Medium-term, Phase 2, pressure stays elevated. Later outcomes depend on funding conditions, not narratives. Dollar funding stress signals. Credit spreads and refinancing pressure. Equity breadth beneath the surface. If liquidity stays supportive, risk can extend. If funding tightens, Phase 2 can slide into Phase 3 quickly. Same system, different pressure. Systems break mechanically, not emotionally. Headlines lag plumbing. That is why our strategy stays signal first. We do not need to be early. We just cannot afford to be late.